In this video, we'll be going over IRS Form 4952, Investment Interest Expense Deduction. So this is a tax form that you may file with your income tax return if you incur any interest expense related to investment income. So you cannot deduct any interest expense that exceeds your interest in or investment income. And there are a couple of other rules that may apply based on your tax situation. So we'll go through this form step by step, and we're going to start with the taxpayer information at the top of the form. So let's just say that our hero, John Doe, is looking to deduct this on his tax return. And because he's a Schedule A filer, this would ultimately go down to Schedule A on his tax return. Depending on your tax status, there are a couple of other things that places that this deduction may come from. So there are three parts to this tax form. Part one will use to calculate the total investment interest expense. In part two, will net out or calculate the net investment income. And then in part three, we're going to determine how much you can deduct in the current year and how much has to be carried forward to future tax years. So let's go ahead and start with part one. In line one, we'll enter the investment interest expense that was either paid or incurred or accrued during the tax year. So according to the form instructions, this specifically includes any investment interest expense that was accrued on a loan or part of a loan for property held for investment. So this could be for a rental real estate property. This could be for investments that you hold, but you secured a loan. Investments that maybe you bought on margin. It also includes any interest expense that was reported to you on a Schedule K-1 from either a partnership or an S corporation. So you can include certain amortization on bond premiums for taxable bonds if you purchased them between 1986 and 1988. That's kind of a rare instance. So if you need to look that up, the specifics, they're covered in our article. However, the investment interest expense does not include any personal interest like your home mortgage. It doesn't include any interest that's allocable to a passive activity. You would generally use IRS Form 8582 to deduct any passive activity loss limitations. It does not include any interest that's capitalized. It doesn't include interest that's related to tax-exempt interest income. So if you bought municipal bonds on margin, you wouldn't be able to do this. And then it does not include any interest expense on indebtedness related to life insurance, endowments, or annuity contracts issued after June 8th of 1997. So just keep that in mind. And again, all of these we do cover in our article. So if you really need to go down into the details on a particular item, feel free to check it out. I'll give you instructions at the end of this video, or you can just hit the link in the show notes. So in part two, so in this case, we had the investment interest expense, and then line two contains anything that was previously disallowed on the prior year Form 4952. So we'll show this on line 7. So you would dip into last year's form and then carry over whatever this line 7 amount is. So let's just assume that John Doe's line 7 from the prior tax year was $3,000. You would add those two together, and $8,000 is the maximum total investment interest expense that we could possibly deduct in the year. But before we get to that, we're going to calculate net investment income so we can actually figure out what the ceiling is for the amount that we can deduct this year and what we need to carry forward to future years. So starting with line 4A, we're going to enter any gross income from property that was held for investment. So it doesn't include any net gain from selling property. That would go into line 4D. But it does include property held for investment that produces interest income, ordinary dividends, except for any Alaska Permanent Fund dividends. That's specifically from the form instructions. So annuities, royalties, you can include investment income that's reported to you on a Schedule K-1 from either a partnership or an S corporation. So if you're reporting the interest expense, be sure from a K-1, be sure to include the actual investment income from that K-1. You can also include net passive income from a publicly traded partnership. You would have to dig into the Treasury regulations to make sure that you comply with that part of it. Again, specifics are in our article. And then if you're filing IRS Form 8814, which is the parent's election to report your child's interest and dividends, then you can also include some or all of your child's income from that form. So let's just say John Doe did this. He's got $3,000 of gross income. In line 4B, we're going to enter the amount of qualified dividends. You would find this on your form 1099-DIV. I believe that's line 1B. Or this would also match line 3A from your form 1040. So, if you have multiple 1099s, the line 1B numbers should add up to the amount that's on your form 1040 line 3A. You would enter that same number here. And then on line 4C, you subtract the qualified dividends. You do have the option to add them back in later in this form, but as you'll see, qualified dividends and then net capital gain is another one. Both of these are subject to a preferable tax treatment, so it may not be in your best interest to include that in income here if for some reason, unless you actually have such a large investment interest expense that you can include it here and then it would be completely covered by your expense deduction. So pay particular attention to both the line 4C and then as we get into the net capital gain, because you'll back that out and then you have the option to add that back in if it suits you. So let's just say that line 4C contains the amount of gross income, minus the qualified dividends. In line 4D, we're going to enter the net gain from the disposition of property held for investment. So this is basically your capital gains. So when you calculate this amount, you need to include any capital gains distributions from mutual funds and then any capital loss carryovers. So in this case, John Doe received or realized a net gain of $2,000. And then in line 4E, you're going to enter the smaller of either this amount or the net capital gain from the disposition of property held for investment. So the net capital gain is defined as basically your net long-term capital gain minus your net short-term capital gain. So that's all this is. So think of line 4D as net total capital gain, and then think of net capital gain as your net, as the amount of long-term capital gain, if net gain here is your total capital gains, then the net capital gain is basically how much of that is your long-term capital gain over your short-term capital loss from the disposition of property. So if you canceling out gains with short-term capital losses, then your net capital gain would be the amount of long-term capital gains that did not get canceled out by a short-term capital loss. So in this situation, John Doe had $2,000 of net capital gain, and $1,000 of that was long-term capital gains. So these two can be the same if 100% of your net gain happened to be long-term capital gain. In this case, this would be the same. It would be 2,000 and then 2,000 here. And then in line 4F, you would subtract those two from each other. So in that hypothetical situation, it would result in 0. In this actual situation, it's $1,000. Now, in line 4G, this is where you get to add back any amounts from 4B or 4E that you choose to include in investment income. And realize this depends on your tax bracket, but you would have to compare, the taxes that you could possibly pay on your qualified dividends. So let's say that you're in a tax bracket that realizes a 0% capital gain. It would be either 0, 15%, or 20%. So even though those are preferential to ordinary income tax rates, you still would need to take a look at, the total amount of investment interest expense, and then where your capital gain, your qualified dividends and your long-term capital gains would be taxed. And if they're taxed at 0%, maybe you choose to carry forward any of the investment interest expense. If they're being taxed at 20%, maybe you say, hey, you know what? That's still good enough. I'm reducing my tax bill, even if it's not the biggest bang for the buck at my ordinary income tax rate. I'm still saving that 20% capital gains tax. So in this case, John Doe decided to take $1,000 from, so line 4B and 4E are $2,000. He decided to take $1,000 of that and include that in his investment income. And then that will be kind of nullified by the interest expense down here in the bottom. So to calculate the total investment income, we take line 4C, 4F, 4G, we add it all together, and we get to $4,000. So line 5 includes investment expenses, which are your allowed deductions other than an interest expense directly related with the investment income. For example, if you had depreciation or depletion that was allowed on these assets, you would enter that as an expense here. So you would also include anything that was reported to you on your K-1 by a partnership or S corporation, but only if you're allowed to deduct that on your tax return. Investment expenses do not include any deductions used to determine your income or loss from a passive activity. And you cannot include any miscellaneous itemized deductions, which aren't allowed until at least tax year 2026 as it currently stands. So in this case, John Doe, he's reporting $1,000 of investment expenses, which we're going to back out by subtracting this number from the $4,000 of investment income. And we arrive at $3,000 of net investment income. Okay. So just think if we go back to line 4G and he decided not to include any of that in income, then we basically would have $3,000. And then this would become a $2,000 net investment income. Okay. So that is completely John Doe's option. In this case, he decided to report it this way. So line 7 happens to be the amount that you're going to carry forward to the next tax year. So you're going to subtract this $3,000 from line 3. So the total expense was $8,000. We're going to subtract the $3,000 and put that in line 7. And then in line 8, we're going to enter the smaller of either line 3 or line 6. So let's imagine that this happened to be $2,000 of expense, but we had $3,000 of income. In this case, you wouldn't have any carry forward, and then you would only use the $2,000 that's reported up here, and then you would just pay regular tax on the additional $1,000 of income. So that's how you would do this. There are special considerations. So for individual taxpayers, this amount, this line 8 amount, gets reported on Schedule A, line 9, even if part or all of it is attributable to a partnership or an S corporation. However, if part of it is due to royalty income, you would be reporting that on Schedule E. If there's any part that's attributable to a trade or a business that's not a passive activity, then you would have to research that schedule where you report the expenses for that other activity. So Schedule F for farm income, for example. There are also special considerations for estates and trusts, at-risk limitations, which means you're only able to take tax deductions up to the amount that you've invested. So most people, if you're investing all of your money and, or if whatever your asset is fully covered by you, you don't have any guarantees, any stop losses, any of that, then your at risk is basically the entire investment. But if you do have any at-risk limitations, then you would need to complete IRS Form 6198 to help you determine how much of this would be allowed. If you're subject to alternative minimum tax, deductible interest expense may be an adjustment item for AMT purposes. So that would be something you calculate on IRS Form 6251 to make sure that you're not falling afoul of any AMT considerations. So that's all we have for this video. I will put links in the show notes to not only the article, but articles and videos we've created on the different forms mentioned in this video. So if you like our articles, feel free to subscribe to our newsletter. Every week we try to put out Tax Tips Tuesday. So basically anything that's current information from the IRS. And then every day that we publish, we usually send a copy of the article to your inbox. And then if you like our YouTube videos, subscribe to our YouTube channel. So if you have any questions or comments, or if there's another topic that you'd like to see covered in an upcoming video, then hit me up in the comments section. Thank you very much and have a great day.